just a piece of plastic. Remember, I see.
Don't carry cash, carry American Express travel check.
Holiday, American Express vacation, and every pleasant Hawaiian, the most out of your vacation.
To a
Whatever you're doing, American Express helps you. Just a reminder, when you have an illusion,
come to the right place. I can help you.
That's
the corporate card for small business usually.
How the hell did we get here? Long before credit cards became a common means of payment, there was something called the Diners Club Card. This payment card was started in 1949 by a man named Frank X. McNamara. The Diners Club Card was the first real payment club card in the world. It enabled users to eat at restaurants on credit and be able to pay their bills off at the end of each month. However, it wasn't really truly a credit card, it was a charge card, and it was the first of its kind to not only thrive, but survive. When he started the Diners Club Card in 1949, he discovered something insidiously ingenious. Charge cards, that were later be known as credit cards, tapped into the very essence of human nature and greed. By paying with a credit card, you disconnected yourself from the pleasure of buying something with the pain of payment. It makes you emotionally feel like you're getting something for free when we know that's not the case. One of the most efficient ways to make money is to get people into debt and make them debt slaves. There is a reason some of the biggest dynasties throughout history come in the form of bankers. That's because all you have to do is hand someone money at an interest rate, and that's literally it. There's no fulfillment process, you don't have to manufacture and ship them a product. All you have to do is sit back and let your debt slaves work to pay off the loan. So ideally, you'd want people to take out an incredibly large loan, like a mortgage on a house, so they're trapped for it for half or even their entire life. Alternatively, you'd want them to have an insanely high interest rate so they can never pay it back. Now, this would obviously trap poor people the easiest, and credit cards became the perfect vehicle for doing so. It allowed you to apply the same psychology that traps people into giant loans, like for a house, but with everyday purchases. I mean, just look at it. It's just a piece of plastic. Just one purchase I can't afford right now. I'll pay it off. Until they don't. And before you know it, they've racked up so much credit card debt that they can barely afford to pay off the interest every month. And that's exactly how things played out. Today, the average American adult has 3 credit cards with an average balance over $5,500, whilst credit card companies have hauled in over $176 billion in income in 2020 alone. That's how credit cards became modern-day loan sharks. Working off of the success of the Diners Club Card, Bank of America released the world's first general-purpose credit card in 1958, and they called it the Bank Americard. Now, because there was no magnetic strip back in the day and there was no way to keep track of any purchases, obviously Bank of America lost millions. Back in the day, credit card fraud was insanely easy, but what they lost in money, they gained in user customer base. Bank of America's way to pay became popular in 1996. They started licensing it to other banks. Then a merger in the 70s created Visa, and the credit card competition was officially on. By the 80s, most credit cards came with a magnetic strip. This opened up the floodgates for more and more banks to start offering their customers credit cards. People loved it. They were spending money that wasn't theirs. Along with other factors, household debt in the US was skyrocketing. The business model worked perfectly, but there was still something missing, and that thing was profit. At the time, these credit cards were only charging about 4 to 5% in interest, compared to today's average of over 16%. Sure, banks were making a modest amount of money off of the interest that they were charging, but in most cases, they were legally barred from raising the interest rates up to a certain level. They needed a way to charge people more. They needed to turn this genius new tool that made people think that they were buying stuff for free into a loan sharking tool. And by the late 80s and early 90s, they found it. At the time, most states in the US had lots of regulations that prevented credit card companies from raising interest rates. But then one state, South Dakota, eliminated its cap on credit interest rates. The state had been cash-strapped for decades, and charging more interest was their Hail Mary last-ditch effort to avoid drowning in bankruptcy. And it got even better for credit card companies. Just a few years later, the US Supreme Court passed the Marquette decision, allowing banks to export their interest rates to other states. This was incredibly important because it meant that if a bank was based in South Dakota, they had an interest rate of 25%. They could charge that same percentage all over the US, regardless of the interest rate laws in other states. Effectively, the interest rate cap on other states became meaningless. Suddenly, all the banks wanted to move to South Dakota. And because they could charge a lot more interest, they started offering credit cards to everyone. College students, young adults, the unemployed. Everybody gets a credit card. But if you were one of these insanely risky individuals, you would just have to pay an incredibly high interest rate that would keep you trapped for life. It got to the point where Citibank was one of the most profitable banks in the world in the early 2000s. Then the Supreme Court passed another bill called Smiley. It removed the last bits of regulation on fees and interest, and it basically gave banks free rein to start raking in as much money as they could. The results? Things like 36% interest rates or changing clients, interest rates at a moment's notice. A 36% interest rate meant that if you took 2 years to pay back a $10,000 credit balance, you would actually be paying the bank over $14,000 and around $590 every month. Most people can't even afford $600 a month and end up being trapped for much longer. Even people who had never missed a payment, all of a sudden realized that their interest rates had tripled. And there was pretty much nothing that they could do about it. And credit card companies were just getting started. Evidently, some people had money to burn. Why else would they pay an outrageous fee to carry a simple credit card when they could carry a Discover card that charges no annual fee, yet pays cash back on every charge? This means it puts money in your pocket instead of burning a hole. By the 2000s, credit card usage had doubled, even in low-income households. After taking control of interest rates, their next target was getting new customers, and obviously the client base they were targeted were young, impressionable college students. Most of them wanted extra cash and wouldn't be bothered to read the fine print, a perfect combination. Most of them were also likely to miss payments, which meant credit card companies could slap them with late fees and penalties. A credit card company's worst nightmare is a customer who pays everything on time, because they get the benefit of having all the perks of having a credit card without paying any of the high interest that comes with having a credit card. What they really want are revolvers, people who can't really afford to pay off the debt, so their debt just keeps getting bigger and bigger and bigger and bigger. American credit card companies were starting to look like high-class loan sharks. They would hire teams of lawyers to write their contracts and then bury hundreds of loopholes in the fine print. These loopholes gave them the power to raise interest rates as much as they wanted, even if a customer missed a single payment on another credit card loan. They could choose public holidays or weekends for payment due dates so that there was a greater chance that your money would arrive late. They would even advertise going paperless to save the planet or the environment, when in reality, they know that people are less likely to read the fine print if it's in an email. Looking for even more customers, credit card companies started offering attractive rewards and cashback rewards for using their cards. They would offer 0% fees for the first 6 months to a year to get you used to missing payments and not feeling the pain of getting charged interest until it becomes a habit. They would even lower their minimum payments from 5% to 2%. Today, the average American family has over $8,000 in credit card debt, and most of it's collecting more and more penalties for late payments. And even if the families declare bankruptcy, they still get offers from dozens of credit card companies for even more money they can spend. Now, all of this sounds bad, but there is a way to fight back and to beat the credit card companies at their own game. Literally, the only thing you need to do to make sure that you don't get screwed over by any credit card companies is 1. Don't buy what you can't afford. If you wouldn't use your cash on it, don't use a credit card on it. And 2, pay it off every single month. If you just do those 2 things, you will never pay a dime on interest and fees to credit card companies.